Cryptocurrency, dead or alive? Hey crypto crew, Andrew here, your friendly neighborhood cryptocurrency expert, back with another episode of BitsPuls. Today, we're diving into the world of digital money, breaking down what makes it tick and why, despite all the ups and downs, it's still causing a stir. Buckle up, because this is going to be a wild ride. Now, if you're new to the game, let's get the basics down. Cryptocurrency, yeah, those digital coins that are all the rage, is basically a digital currency. Think of it as an alternative to the good old US dollar or any other government-backed money. But here's the twist. Cryptocurrencies are powered by cryptography. That's some fancy math stuff that makes it super secure to spend, without needing a bank or the government to play referee. Bitcoin, the OG cryptocurrency, was born to be a payment method that wasn't controlled by any single entity. Imagine paying for a coffee without a bank validating the transaction. That's what Bitcoin aims to do. Ethereum, another big player, also uses blockchain technology, but it's more than just peer-to-peer payments. It's about creating entire financial ecosystems that operate without a central authority. Think insurance without the insurance company, or real estate transactions without the title company. Crazy, right? And then there's a whole zoo of altcoins, which is basically any cryptocurrency that isn't Bitcoin. A lot of these altcoins have popped up with the promise of offering unique solutions using blockchain technology. Some of them are solid, some are, let's just say, not so much. Now, you might be wondering, why would anyone invest in this digital hullabaloo? Well, it's the same reason anyone invests in anything. They hope its value will go up and they'll make a tidy profit. If the demand for Bitcoin increases, for example, the laws of supply and demand kick in, and its price could go up. If everyone starts using Bitcoin for everyday payments, the demand goes up, and its price in dollars will increase. So if you bought Bitcoin before the price hike, you could theoretically sell it for more dollars than you paid for it. That's how you make a profit. The same principles apply to Ethereum. Ethereum's currency, is used to power the Ethereum blockchain, which is a playground for developers to create financial apps without relying on banks or other third-party institutions. The more applications are built on Ethereum, the higher the demand for Ether theoretically gets. But, get this, some people don't even see cryptocurrencies as investments at all. Bitcoin enthusiasts, for instance, think it's a much better monetary system than our current one. They want us to spend and accept Bitcoin as a regular payment method. They'd say one Bitcoin is one Bitcoin, and that Bitcoin shouldn't be measured against the USD, but by its value as a new monetary system. Alright, let's address the elephant in the room. Why is Bitcoin still a thing? It's been declared dead, worthless, a scam, you name it. Its price is prone to wild swings, like a roller coaster on overdrive. Remember back in 2021 when Bitcoin hit $60,000? Then it crashed to around $17,000 in 2022. A lot of experts and investors said it was toast, but guess what? It bounced back, hitting a series of record highs in early 2024. Part of that surge is thanks to the SEC approving spot Bitcoin ETFs in January 2024. That gave big-time asset managers like Fidelity and BlackRock the green light to offer Bitcoin exposure to their clients, making it easier for them to hold Bitcoin in accounts like IRAs and taxable brokerage accounts. Oh, and a handful of Ethereum ETFs also got the nod in July 2024. But Bitcoin's 2024 price surge isn't just about ETFs. Every 4 years, there's a big event called Bitcoin halving, where the mining reward gets cut in half. The most recent halving happened in April 2024, slashing the reward from 6.25 to 3.125 Bitcoins. The anticipation of fewer Bitcoins entering the market drives up the price. And don't forget the surge in interest rates in 2022, which made growth stocks take a hit. That had a similar impact on Bitcoin. Investors tend to favor security over volatility when things are uncertain. But with talk of interest rate cuts circulating in 2024, some investors might be more willing to take risk with assets like Bitcoin, leading them to jump back in. And let's not forget about the die-hard Bitcoin enthusiasts who preach that looking at Bitcoin through the lens of fiat currencies like the US dollar is missing the whole point. They believe Bitcoin's true value is in being a new monetary system. But one thing about Bitcoin seems predictable: its volatility. In the short term, both the Bitcoin bulls and the bears could be right. Bitcoin will rise, Bitcoin will fall. Right now, though, it looks like the bulls are winning. So, how does this whole crypto thing work? Well, it's all powered by a technology called blockchain, which is like a tamper-proof record of transactions. It keeps track of who owns what. Blockchain solved a big problem that previous attempts to create digital currencies faced, preventing people from making copies of their holdings and trying to spend them twice. Individual units of cryptocurrencies are called coins or tokens, depending on their use. Some are meant to be used for buying goods and services, others are stores of value. And some can be used to participate in specific software programs, like games or financial products. Now, let's talk about how these cryptocurrencies get created. One common method is mining, which Bitcoin uses. Bitcoin mining is a bit of a power hog, where computers solve complex puzzles to verify transactions on the network. The lucky owners of those computers get to receive newly created Bitcoin as a reward. Other cryptocurrencies use different methods to create and distribute tokens, and many have a much lighter environmental impact. For most folks, the easiest way to get cryptocurrency is to buy it, either from an exchange or from another user. And here's the thing, why are there so many different types of cryptocurrency? Well, Bitcoin is not the same thing as cryptocurrency in general. While Bitcoin is the first and most valuable, the market is huge. There are over 2 million different cryptocurrencies out there, according to coinmarketcap.com, a website that tracks the market. Some cryptocurrencies have market valuations in the hundreds of billions of dollars, while others are obscure and essentially worthless. If you're thinking about dipping your toes into the crypto world, it's best to start with one that is commonly traded and relatively established. These coins usually have the biggest market capitalizations, but even if you pick carefully, there's no guarantee of success in this volatile space. Sometimes, a problem in the interconnected crypto world can have wide-reaching consequences for asset values. Just look at what happened in November 2022, when the cryptocurrency exchange FTX had liquidity issues amid a spike in withdrawals. The fallout spread, causing cryptocurrencies big and small to see their values plummet. Now, here's a question that's been bouncing around. Are cryptocurrencies financial securities like stocks? That's a bit of a gray area right now. Generally speaking, a security in finance is anything that represents a value and can be traded. Stocks are securities because they represent ownership in a public company. Bonds are securities because they represent debt owed to the bondholder. Regulators are increasingly signaling that cryptocurrency should be regulated similarly to other securities, like stocks and bonds. But with the June 2024 Loper Bright Enterprises v. Raimondo Supreme Court ruling, that might change. Congress might have to clearly define crypto regulation through laws instead of letting the SEC enforce rules based on its interpretation. That could have major implications for the future of the crypto asset class. Now, let's talk about the pros and cons of cryptocurrency. It's a topic that sparks passionate opinions from all kinds of investors. Here are some reasons why some people think cryptocurrency is a revolutionary technology, while others see it as a passing fad. Cryptocurrency proponents love the fact that it takes central banks out of the equation when managing the money supply. They argue that over time, central banks tend to reduce the value of money through inflation. In communities that haven't been well served by the traditional financial system, some people see cryptocurrencies as a promising opportunity. Pew Research Center data showed that Asian, Black, and Hispanic adults were more likely than white adults to say they've invested in, traded, or used cryptocurrency. Other advocates like the blockchain technology behind cryptocurrencies because it's a decentralized processing and recording system, which can be more secure than traditional payment systems. Some cryptocurrencies allow owners to earn passive income through a process called staking. Crypto staking involves using your cryptocurrencies to help verify transactions on a blockchain protocol. Though there are risks, staking can allow you to grow your crypto holdings without having to buy more. But now for the other side of the coin, the cryptocurrency cons. Many cryptocurrency projects are untested, and blockchain technology itself hasn't yet gained widespread adoption. If the underlying idea behind cryptocurrency doesn't reach its potential, long-term investors might never see the returns they hope for. For short-term crypto investors, there are other risks. Crypto prices are notoriously volatile. While this can lead to quick profits for those who buy at the right time, many others have lost money by buying just before a crash. These wild swings in value can also undermine the very projects that cryptocurrencies were created to support. For example, people might be less likely to use Bitcoin for payments if they're not sure what it'll be worth the next day. And let's not forget the environmental impact of Bitcoin and other projects that use similar mining protocols. A study by the University of Cambridge found that worldwide Bitcoin mining consumes more than twice as much power as all residential lighting in the US. Some cryptocurrencies use different technology that requires less energy, but the environmental footprint is something we can't ignore. Governments around the world are still figuring out how to handle cryptocurrency, so regulatory changes and crackdowns can affect the market in unpredictable ways. Get a welcome bonus of up to $5,500 for newcomers on the BitsPuls cryptocurrency exchange. Click the link in the video description to get started. Now, let's dive into the legal and tax issues surrounding cryptocurrency. There's no doubt that cryptocurrencies are legal in the US, although China has basically banned them. Ultimately, whether they're legal depends on each individual country. But legality is just one part of the legal picture. We also need to consider how crypto is taxed and what you can buy with it. In most places, there's no requirement for cryptocurrencies to be accepted as legal tender. That means they don't have to be accepted as payment for debts. The US dollar, on the other hand, must be accepted for all debts, public and private. Countries worldwide are taking different approaches to cryptocurrency. Right now in the US, what you can buy with cryptocurrency depends on the seller's preferences. And let's talk about crypto taxes. Again, the term currency is a bit misleading when it comes to taxes. Cryptocurrencies are taxed as property, not currency. So when you sell them, you'll pay tax on any capital gains, the difference between your purchase and sale price. If you're given crypto as payment or as a reward for an activity like mining, you'll be taxed on its value at the time you received it. So, the big question, is cryptocurrency a good investment? That depends. It's a relatively risky investment, no matter how you slice it. Generally speaking, high-risk investments should make up a small portion of your overall portfolio. One common guideline is no more than 10%. You might want to focus on shoring up your retirement savings, paying off debt, or investing in less volatile funds made up of stocks and bonds. There are ways to manage risk within your crypto portfolio, like diversifying the range of cryptocurrencies you buy. Crypto assets can rise and fall at different rates and over different time periods, so by investing in several different products, you can somewhat insulate yourself from losses in one of your holdings. But perhaps the most important thing when investing in anything is to do your research, especially when it comes to cryptocurrencies. They're often tied to specific technological products that are being developed or rolled out. When you buy a stock, it's linked to a company that's subject to well-defined financial reporting requirements, giving you a sense of its prospects. With cryptocurrencies, it can be more challenging to figure out which projects are truly viable. If you have a financial advisor who knows their way around crypto, it might be worth getting their input. For new investors, it's also a good idea to see how widely a cryptocurrency is being used. Most reputable crypto projects have publicly available metrics showing data like the number of transactions on their platforms. If a cryptocurrency's use is growing, it might be a sign that it's gaining a foothold in the market. Cryptocurrencies also usually make white papers available, explaining how they work and how they plan to distribute tokens. If you're considering investing in less established crypto products, here are some questions to ask yourself. Who's leading the project? A recognizable and well-known leader is a positive sign. Are there any other major investors putting money into it? It's a good sign if other reputable investors are interested. Will you own a portion of the company, or just currency or tokens? This distinction is crucial. Being a part owner means you get to share in its earnings, while buying tokens just gives you the right to use them. Is the currency already developed, or is the company raising money to develop it? The further along the product is, the less risky it is.